Welcome to the Pro Ticker Deep Dive.
It is really good to be here today.
Yeah, it's well, today is Wednesday, February 25th, 2026. And if you have been watching the markets today or even just glancing at your phone notifications, you can practically feel the tension in the air.
Oh, absolutely.
It's thick. It's really heavy.
It certainly is. The financial world is essentially holding its breath right now. I mean, you walk onto a trading floor today and it's quieter than a library. People are just waiting.
Yeah, it's late afternoon right now. The closing bell is just moments away, and we are staring down the barrel of what everyone's calling the main event.
That's right. We've had an incredibly volatile week so far. I mean, selling off hard on Monday, then a bit of a tentative recovery Tuesday and today. Today is the pause. Everyone is just sitting on their hands.
Waiting for Nvidia.
Waiting for Nvidia. It's pure cinema at this point. It is the only show in town.
It really is. It feels less like an earnings report and more like the Super Bowl of capitalism, or maybe the season finale of the global economy. But before we get to Jensen Huang and the famous leather jacket, we have to set the stage properly for you. Because this isn't just about one company reporting numbers, is it?
No, absolutely not. If you zoom out, we are looking at the violent collision of three massive tectonic narratives all happening at the exact same time. It's a perfect storm.
Okay, let's unpack this for the listeners. What are the three forces colliding today?
First, you have the AI supercycle. The big question hanging over everything like a sword of Damocles is whether this is real sustainable growth or are we at a massive bubble about to burst? Nvidia is the referendum on that question.
Yeah, it's the ultimate test.
Second, you have a rapidly shifting political landscape. We just had President Trump's State of the Union, but even more importantly, we had a major Supreme Court ruling on tariffs this week that has completely changed the playbook for the administration.
We're definitely going to dive into that because the market reaction there was honestly surprising to me. And the third force?
The third is what we are calling the Great Rotation. For years, the story has been simple, right? Buy big tech, buy the Magnificent Seven, and go to sleep. But suddenly, money is moving. It's leaving the mega caps and flooding into small caps, into value stocks, and real assets like gold.
So we have a tech bellwether reporting earnings that could crash the market, a constitutional crisis over trade policy, and a fundamental shift in where money is flowing for the first time in years.
Exactly. It's a lot to process.
All right, let's start with the main event, segment one, which is the Nvidia event.
The bellwether of the AI economy.
Just to give you a sense of scale here, because I think we get desensitized to these numbers, we are talking about a company with a market cap of roughly $4.7 trillion.
Which makes it the most valuable company in the S&P 500.
Yeah.
It has eclipsed Apple. It has eclipsed Microsoft. To put that in perspective, $4.7 trillion is larger than the GDP of Germany. It's larger than the GDP of Japan. We are talking about a single corporation that is economically larger than the world's third or fourth largest economies.
That is just mind-boggling. And because it's that big, the earnings report isn't just about Nvidia's stock price.
No, it's a macro event. It moves the entire index. If Nvidia sneezes, the market catches a cold. If Nvidia misses earnings, the entire AI trade could unravel. Investors are looking for confirmation that the party can continue. The psychology of the entire market is resting on this one report.
So let's talk numbers. What are the expectations? What does success look like tonight?
The expectations are astronomical. Consensus estimates from analysts are expecting profit to surge nearly 70% from a year ago. We are looking at a profit figure around $37.5 billion.
Hold on. $37.5 billion in profit.
In one quarter. 3 months.
Let me do some quick napkin math here.
Yeah.
That implies they're making over $400 million in profit per day.
Correct. Every single day. Saturday, Sunday holidays, $400 million in pure net income.
I struggle to even wrap my head around that kind of cash flow.
It's unprecedented in the history of capitalism. But here is the kicker, and this is where it gets dangerous for investors. Simply hitting that number might not be enough.
Why? If you make $37 billion in a quarter, how is that not enough?
Because of the whisper numbers. The official estimates are one thing, but the market expectation about what the traders are actually betting on and what's priced into the stock is often much higher. Investors are looking for a blowout, they need to see a massive beat, and more importantly, they need to see incredibly strong guidance for the rest of 2026. If Nvidia just meets expectations, the stock could actually sell off 5 or 10%. It's priced for perfection.
That is a terrifyingly high bar to clear.
Yeah.
So when the report drops, what are we looking at under the hood? It's not just the top-line revenue number, right?
No, the devil is in the details. The headline number will get the flash on the screen, but the pros are digging into 3 specific things. The first is Blackwell.
The new chip architecture.
The new chip. The B100 and B200 series. These are the successors to the Hopper chips, the H100s that started this whole frenzy back in 2023. The question is whether they are shipping on time. Is demand outstripping supply? We know the demand is there, but can they make them fast enough? There have been rumors about overheating issues in the server racks.
Oh, really? I hadn't heard that.
Yes, because these chips draw so much power, the cooling requirements are intense. If there's a delay in shipping because they are tweaking the cooling design, the stock will get hit. Investors need to hear that Blackwell is shipping in volume right now.
And supply chains are tricky things. If one component is missing, you have a paperweight, not a supercomputer.
Precisely. Which brings us to the second metric, which is gross margins. Last quarter, Nvidia's margins were in the mid-70s. That is software-level profitability on a hardware product. It's unheard of. Usually hardware margins are 30, maybe 40%.
Wow, that's a massive difference.
It is. But ramping up a new chip like Blackwell is expensive. The manufacturing process at TSMC is more complex. Investors need to hear that supply chain costs aren't eating into those margins. If margins drop to, say, 71%, the street will panic.
They'll panic over 71% profit margins. That sounds incredibly greedy.
It is greedy, but that's the market we are in. Perfection is priced in.
So profit margins and the new chip?
Yeah.
What else are they watching?
The roadmap. The CFO, Colette Kress, has previously mentioned a $500 billion opportunity through 2026. Investors want to hear about Rubin.
Rubin. Is that a person or a chip?
It's named after Vera Rubin, the astronomer. It's the next generation architecture after Blackwell. Nvidia is moving so fast they are already talking about the chips for 2027. This is crucial because investors need to know this isn't a one-time boom. They need to know there is a pipeline.
So they need assurance this isn't a flash in the pan.
Exactly. If they give a solid update on the Rubin roadmap that signals longevity, it tells the market we aren't just selling shovels for one gold rush, we are building the infrastructure for the next decade.
Now, there is a massive geopolitical elephant in the room regarding Nvidia, and that is China.
The China wildcard. This is fascinating and honestly a bit like a spy novel.
For most of 2025, Nvidia was effectively locked out of selling their top-tier chips to China due to U.S. export controls.
Right. The Biden administration and now the Trump administration have viewed AI supremacy as a matter of national security. You don't sell your best weapons to your rival. And that was a huge chunk of Nvidia's revenue that just evaporated. But there are reports circulating about a potential workaround.
A deal with the Trump administration.
Exactly. The rumor is that a deal has been struck allowing Nvidia to sell the H200 chips, which are very powerful, though not the absolute bleeding-edge Blackwells, to China. But there's a catch.
There's always a catch.
The U.S. government would take a cut of the sales, a tariff, essentially, or a massive licensing fee.
Wait, so the U.S. government becomes a commission-based sales agent for Nvidia?
In a way, yes. It fits the current administration's transactional view of trade. If you're going to sell to them, we want a piece of the action to fund our treasury. But for Nvidia, even with a government cut reopening the Chinese market is a massive revenue unlock. We're talking billions of dollars sitting on the table.
And it seems like China is desperate for these chips. I saw the news about DeepSeek and it sounded wild.
The DeepSeek incident, yes. This is a Chinese research lab that reportedly trained a massive AI model, one that rivals GPT-5 using NVIDIA Blackwell chips.
Which they weren't supposed to have.
Which they absolutely were not supposed to have. They are banned.
So how did they get them?
That is the question keeping the Department of Commerce awake at night. The theory is gray markets. Shell companies set up in Singapore, Malaysia, or the Middle East, buying the chips and then quietly reshipping them to China. It suggests a porous blockade.
It's basically a tech smuggling ring.
Exactly. But from an investor's perspective, strip away the politics for a second, it highlights just how desperate the global demand is. Even with sanctions, even with the threat of jail time, people are smuggling these chips because the tech is that essential. It proves the moat.
So you have massive demand, a potential reopening of the China market, and huge margins. But let's play devil's advocate here. I look at the chart, and it's vertical. The stock is trading at 25 times forward earnings. Is it too expensive? Are we looking at Cisco in 1999?
That's the debate. But here is where it gets really interesting. If you look at the history, 25 times forward earnings is actually cheap.
Cheap, come on.
Relatively speaking, hear me out. The S&P 500 average is around 22 times right now. So Nvidia is trading at a slight premium to the average boring industrial company. But Nvidia is growing earnings at 70%. Historically high growth tech stocks, think Amazon in 2015 or Cisco in the 90s, traded at 40 times, 50 times, even 100 times earnings.
So you're saying the market is actually being conservative?
Surprisingly, yes. The PEG ratio, the price to earnings growth, is actually very low. If you believe the growth story, if you believe the supercycle is real and not a bubble, Nvidia at 25 times is a bargain. The risk isn't the valuation, the risk is the growth stopping. If growth slows to 10%, the stock collapses. But if it stays at 70%, it's cheap.
That's a big if. But it explains why the market is holding its breath. Everyone is waiting to see if the growth curve bends.
Precisely.
Now moving to our second segment. While everyone is watching Nvidia, the landscape around them is shifting. It's not just a monopoly anymore.
No, and that's a healthy development for the industry, actually. We got some blockbuster news involving Meta Platforms, Facebook, and AMD.
They inked a massive deal.
Massive is the word. Meta signed a multi-year deal to deploy up to 6 gigawatts of AMD's GPUs and CPUs.
6 gigawatts. I mean, Doc Brown needed 1.21 gigawatts to travel through time. 6 gigawatts is what exactly?
It's the equivalent of powering a small country, or roughly 6 nuclear power plants running at full capacity just for compute power. This deal involves AMD's Instinct GPUs, the MI450s, and their EPYC CPUs.
Why does this matter so much? Is it just about the volume?
It's about the validation. See, for the last 2 years, NVIDIA had a moat. Not just hardware, but software. CUDA.
The CUD is the software layer that runs on NVIDIA chips.
Right. And everyone uses it. It's the standard. Moving away from NVIDIA is hard because you have to rewrite your code. But Meta has some of the best engineers in the world. By buying AMD, they are saying, we have figured out the software. They are using PyTorch and open source tools to run their AI on AMD chips.
So this breaks the CUDA moat.
It puts a massive crack in it. It tells the market that if you are big enough, if you are a hyperscaler like Google or Amazon, you don't need NVIDIA for everything. You can use AMD for inference or training certain models. It validates AMD as a real alternative.
And the market reacted immediately.
AMD stock surged about 10% on the news. It's a signal that the AI pie is big enough for more than one winner. It's not a zero-sum game yet.
But it hasn't been all green lights for tech this week. We saw a bit of a panic earlier regarding software stocks, the C-spocalypse.
The C-spocalypse, I love that term. It sounds like a bad sci-fi movie.
It felt like one for investors on Monday. Stocks like Salesforce, Workday, the companies that sell software as a service, got hammered. The fear was that AI is just going to replace them.
Right. The narrative was, why do I need to pay Salesforce $300 a seat for a CRM if an AI agent can just manage my customers for me automatically? We call this the substitution phase of fear. Investors worried that AI is a substitute for software. If AI can code, why do I need GitHub? If AI can write contracts, why do I need DocuSign?
But then Tuesday happened, and those stocks rebounded. Salesforce and DocuSign bounced back. Why the sudden change of heart?
Because Anthropic released their new model, and the positioning was very specific. They didn't pitch it as a replacement. They pitched it as an orchestration layer.
An orchestration layer. Explain that to me like I'm 5.
Okay, imagine you are building a house. In the substitution fear, people thought AI was a robot that would replace the carpenter, the plumber, and the electrician. But Anthropic is saying, no, AI is the general contractor. The AI doesn't replace the tools, it uses the tools.
So the AI uses Salesforce.
Exactly. It clicks the buttons, it fills the forms, it navigates the menus, it makes the software more valuable because it makes it easier to use. Instead of a human spending 4 hours entering data into Salesforce, the AI does it in 4 seconds. But you still need Salesforce to store the data and manage the process.
So we moved from AI will kill software to AI will drive software.
Exactly. We shifted from the substitution narrative to the orchestration narrative, and that calmed the market's nerves significantly. It means these software companies have a future. They just need to adapt to being tools for AI agents rather than just tools for humans.
It's fascinating how quickly the narrative flips.
Yeah.
One day you're obsolete, the next day you're the engine.
That is the speed of this market right now. If you blink, the thesis changes.
Okay, let's pivot to segment 3, the macro-political firestorm. Because while tech is doing its thing, Washington is well being Washington. And it's messy.
It's been a very busy week in D.C., and not in a way that's usually comfortable for investors.
We have to talk about the Supreme Court. They just handed down a ruling regarding tariffs.
This is huge, and I don't think people realize just how significant this is for the long-term structure of the U.S. economy. The court struck down President Trump's broad use of IEPA powers for tariffs.
IEEP. What does that stand for again?
The International Emergency Economic Powers Act. It was passed in 1977. Historically, presidents have used this to impose broad sanctions or tariffs by declaring a national emergency. It's like a break glass in case of emergency button for the economy.
And Trump has been using it aggressively.
Correct. To implement broad tariffs without going through Congress. But the Supreme Court just said no. You cannot use emergency powers to rewrite trade policy permanently. That is Congress's job, Article 1 of the Constitution.
That is a massive check on executive power.
It is. It effectively invalidates many of the administration's planned tariff policies, or at least forces them to go through Congress. And do you know how fast Congress moves?
Glacially.
Exactly.
And the market liked this ruling.
The market loved it.
Why? I thought Trump's policies were supposed to be pro-business. Shouldn't the market want him to have the power to protect U.S. industry?
It's counterintuitive. Markets generally like deregulation, yes, but markets hate uncertainty more than anything else. They hate the idea that a president can wake up on a Tuesday, get angry at a country, and slap a 25% tariff on everything by Wednesday, causing inflation to spike and supply chains to break.
It's too volatile.
It's chaos. This ruling creates gridlock. It means trade policy will be slower, more debated, and more predictable. It reduces the fear of a sudden global trade war and retaliatory inflation.
Gridlock is good.
In this case, yes. It shifts the focus away from a crisis to just managing the balance of payments. It's boring, and markets love boring when it comes to regulation.
You mentioned balance of payments. It sounds like an accounting term. Why does the average listener care about that?
Fair point. Think of it as the country's checkbook. When we import more than we export, dollars leave the country. Usually to balance that, foreigners buy our debt treasury bonds. If we had a massive trade war, that flow of money stops. The dollar crashes, and the cost of everything you buy at Walmart goes up. By removing the threat of a trade war, the balance of payments stabilizes. It means your dollar keeps its buying power.
Okay, that makes sense. Stability is good for the wallet. But speaking of not boring, we had the State of the Union address.
We did.
And the president floated a theory that tariffs could replace the income tax.
Which is a controversial economic theory, to put it mildly. Mathematically, the U.S. imports about $3 to $4 trillion a year. Income tax brings in over $2 trillion. To replace income tax, you would need tariffs of like 70 or 80% on everything.
Which would cause prices to skyrocket.
Yeah, it would be hyperinflationary. But the market knows the math doesn't work, so they aren't panicking about that specific policy yet. What is interesting is the market reaction to the Sell America trade.
We're seeing the dollar weaken, right? Down about 1.4% in January and February.
Which is weird because usually when the U.S. economy is growing at 4%, which we'll get to, the dollar gets stronger. Investors usually rush to the growing economy. But right now, despite the growth, the dollar is sliding.
Is that because of the Fed?
That is the other piece of political drama, the Fed independence crisis.
This sounds like a House of Cards plotline.
It really does. There are reports of a DOJ investigation into Fed Chair Jerome Powell.
Over what?
Ostensibly over office renovations.
Office renovations, like the wallpaper was too expensive?
Essentially, yes. Spending too much on the conference room. But everyone knows it's not really about the wallpaper. It's about pressure. It's a way to tell the Fed chair we are watching you. Cut rates or else. Then you have the subpoenas regarding Kevin Warsh's nomination to the board. It all creates a picture of political instability at the central bank.
And investors hate uncertainty about who controls the money printer.
Correct. The Federal Reserve is supposed to be independent, apolitical. If it is seen as a puppet of the White House, global investors lose trust in the dollar. They worry that the Fed will print money just to help the president's poll numbers. That erodes trust. That is fueling a flight to safety. But because of the dollar weakness, that safety flight isn't going into cash.
It's going into gold.
It is going into gold.
Which brings us perfectly to segment 4, the economic pulse. Gold is going parabolic.
It's incredible. Gold has surged to record highs, crossing $5,400 an ounce.
$5,400. I remember when 2000 felt expensive. I remember thinking 2,500 was a bubble.
It's a hedge against exactly what we just discussed, institutional instability. When you are worried about the Fed and you are worried about geopolitical tensions, Greenland, Venezuela, Iran are all heating up, you buy gold. Gold has no counterparty risk. It doesn't care who the president is.
What about Bitcoin? Usually the crypto crowds say Bitcoin is the hedge against the Fed. Digital gold.
And that's the fascinating divergence right now. Gold is outperforming Bitcoin on a risk-adjusted basis.
Really? That surprises me.
Yes. Gold is acting like the adult in the room. While crypto remains volatile, swinging 10% on a tweet, gold is steadily climbing. It's saying, I am the store of value when institutions get shaky. Central banks in China, Poland, and Singapore are buying gold. They aren't buying Dogecoin.
So gold is shining. But there is another rotation happening in the stock market, the Great Rotation.
This is the healthiest sign for the bull market we've seen in years.
Explain that for us.
For the longest time, the S&P 500 went up only because the Magnificent Seven, Nvidia, Apple, Microsoft, and the rest went up. If you took those 7 stocks out, the market was flat for 2 years.
Narrow breath. A house built on 7 pillars.
Exactly. But now look at the Russell 2000. That's the index of small cap stocks. 2,000 smaller American companies. In January, the Russell 2000 was up over 5%, while tech was flat or down.
So the little guys are winning.
They are crushing it. And it's not just small caps. 65% of S&P 500 stocks are beating the index. That is massive participation. It means the rally is broadening out.
Why is that happening now?
It's the soft landing actually happening. The economy is resilient. If the economy was crashing, you would hide in big tech. You buy small caps when you think the domestic economy is strong.
Let's look at the data to back that up. The Treasury report just came out.
GDP growth is solid, 4.4% in Q3 2025. Estimates for Q4 are around 2.2%. That is a very strong economy. Most developed nations would kill for 2% growth. We hit 4.4%.
And inflation.
Core CPI is at 2.6%. It's cooling. It's not it's not at the 2% target yet, but it's manageable. It's not the crisis it was in 2022.
But here is the paradox that confuses me, and I think confuses a lot of listeners. Unemployment is low, around 4.5%, but hiring is practically non-existent. Every time I talk to a college grad, they tell me they can't find a job.
This is the labor hoarding phenomenon. It is the defining economic trend of 2026.
A labor hoarding. What does that mean exactly?
Think back to the post-COVID years. Companies struggled desperately to hire. They raised wages. They offered bonuses. They are traumatized by that labor shortage. So now, even if business slows down a little, they are terrified of laying people off. So layoffs are near historic lows.
Okay, so they keep the workers they have.
Exactly. But they are also uncertain about the future, and they are investing heavily in AI. So they aren't hiring new people. They are freezing headcount.
So it's a frozen labor market.
It is. They're betting that they can get more output from the same people by giving them better tools like that AI orchestration layer we talked about earlier. I won't fire you, but I'm not hiring your replacement, and I'm not hiring an intern. I'm buying a GPU instead.
That is brutal for the entry-level worker.
It is creating a lost class of 2026. It's a jobless growth boom. Profits go up, GDP goes up, but job count stays flat.
That feels sustainable for corporate profits, but maybe less so for the American society in the long run.
That is the big risk. If you don't hire young people, they don't gain skills. And 10 years from now, you have a massive skills gap. But for now, Wall Street loves it because it keeps costs down.
And the consumer. How are they reacting to this?
The consumer is holding up. Consumer confidence improved modestly in February after a dip in January. They are shaken, but they are still spending.
Let's talk about who they are spending with. Segment 5. Corporate winners and losers.
This earnings season has been a mixed bag, which again highlights that rotation we discussed.
Let's start with the losers, because the market punished some companies severely this week.
Guidance misses were the theme. If you didn't promise a bright future, you got crushed. The market has zero patience for maybe.
Lowe's, the home improvement giant.
Lowe's beat earnings but gave poor guidance. The stock struggled. This tells us the housing renovation market is still frozen.
It's the interest rates, isn't it?
Exactly. The lock-in effect. If you have a 3% mortgage from 2021, you aren't selling your house to buy a new one at 6.5%. And if you aren't moving, you aren't doing the big renovations that drive Lowe's revenue. You might buy a light bulb, but you aren't buying a new kitchen.
Workday was another one.
This goes back to the AI fear. Workday beat estimates, but the stock crumbled about 9%. Investors are just terrified that AI will eat their lunch regardless of what management says. It's a sentiment problem.
GoDaddy plunged 17%. First Solar Dove, 15%.
Weak bookings, weak sales guidance. GoDaddy signals that small business formation might be slowing down, or that small businesses are using AI to build websites instead of paying GoDaddy.
But there were winners. And this one I found really interesting. Kava Group.
The Chipotle of Mediterranean food zoomed up 9%.
I love Kava. Their harissa chicken is great.
Apparently everyone agrees with you. Same-store sales growth was 3 to 5%. It shows that the fast casual consumer is still showing up.
This feels like the lipstick effect.
Exactly. The economic theory that when people can't afford big luxuries like a house or a new car, They treat themselves to small luxuries. An $18 lunch bowl is the new luxury. They might not be remodeling their kitchen at Lowe's, but they will buy the nice lunch.
And Circle Internet Group.
Up 17%. Strong revenue growth. That ties into the crypto and digital asset infrastructure build-out. Even if Bitcoin is volatile, the plumbing of crypto stablecoins is growing.
What about sectors? How are the broader groups doing?
Healthcare took a beating recently.
Why? Usually healthcare is considered safe.
Not when the government changes the rules. The Trump administration proposed flat Medicare Advantage rates. That is basically a pay cut for insurers when you account for medical inflation. United Health stock dropped significantly. It's a policy risk that materialized out of nowhere.
On the flip side, energy and materials were the top performers in January.
Which proves the great rotation point. Investors are buying real stuff, oil, copper materials, and selling the expensive tech and healthcare names. It's a return to the old economy.
So we have a market that is broadening out, an economy that is growing but not hiring, and a political environment that is both chaotic and gridlocked.
It is a fascinating, contradictory moment.
Let's wrap this up. We've covered a huge amount of ground today on this deep dive. What is the summary here?
We are at a crossroads. We have this great rotation into small caps and real assets like gold, which is healthy. It means the market isn't just a tech bubble, and it's big, but the entire world is still obsessed with the AI capex cycle. Nvidia and Meta are the engines. If those engines stall, the rotation won't save us.
And the risks.
Political instability is the new wall of worry. Fed independence and tariffs are the big unknowns right now. If the Fed loses credibility, all bets are off.
So for the listener tuning in, what does this all mean for them?
If you are an investor, take note that the market is getting broader. It might be time to look beyond the Magnificent Seven. The rally is expanding to the other 493 stocks in the S&P. Diversification is finally working again.
And for tonight,
watch Nvidia, but don't just watch the stock price. Listen to the call. Listen to what Jensen Huang says about demand. Is it accelerating or is it plateauing? Is he worried about China? Is he worried about competition from AMD? That answer will determine the next 6 months of the market.
here's a final provocative thought for you to chew on. We talked about labor hoarding versus AI productivity. Companies are spending billions on Nvidia chips. Massive capital expenditure while hiring is flat.
Right, they are betting the farm on silicon.
Are we about to see a jobless growth boom? Or will the AI bill eventually come due? If companies spend all this money on chips but don't see the revenue return, what happens then? Do we get a recession because of AI spending?
That is the trillion-dollar question. If the productivity doesn't materialize, the layoffs might start later, and they will be ugly.
On that cheery note, keep your eyes on the ticker tape tonight. It's going to be a wild ride.
Indeed. Get the popcorn ready.
Thanks for joining us on this deep dive. We'll catch you on the other side of the earnings call.